The Philippine Stock Exchange off to a positive start this week. The main index was up by 8% to close a hairline away from the 6,600 level on Monday. Value turnover, however, slid to 3.3 billion pesos after recovering to the 4 billion peso mark last Friday. To help us make sense of today's market movements, we're now joined by Sandra Araullo, Chief Investment Officer of ATR Asset Management. Sandra, again, nice to have you on the program.
Good afternoon, Sandy. Good afternoon to your viewers.
Okay, now we're reaching 66 again, but not really going beyond that. Is this a good time, Sandra, to lock in profits, especially for those investors who were able to take that ride from the lows of last year, 2022, at least before stock prices again fall significantly, as other analysts are saying it could still go down to as low as 6.3 here in the near future?
It really depends on what your starting point is, no? Of course, if you were able to time it perfectly and come in the third quarter of last year, year to date, the market is flat. Do you want to be selling at these levels? Actually, I wouldn't advise it because there is such deep value in the market, and we've seen corporates deliver on earnings, especially after the first quarter earnings season has just completed. Relative to the first quarter of 2019, so that would be pre-pandemic, we've shown, or corporates have shown, very convincing, solid track to recovery. I think, if I'm not mistaken, we are above about 39% versus first quarter 2019. So very clearly, we've recovered from the lockdowns caused by the pandemic, and that should be giving investors reason to buy shares of these companies that are bringing in the earnings. But because of the overhang, the other risks out there, there's deep value and negative sentiment in Philippine stocks.
Okay, so don't sell yet if you can help it. Now, we're looking at support levels, Sandra, of 63.50 to 65 that we all hope would hold, of course. We're not making any significant progress either, breaking resistance beyond 66 to 67. Now, under these market conditions, are you seeing investors just staying extremely selective when it comes to their stock picking? And maybe how is this affecting other share prices that have not been moving or that are not the preference, particularly in the broader index?
Actually, I would say that the big headwind is really outside for foreign investor sentiment. The locals are actually a lot more constructive, and there's not any capitulation going on. In fact, if you look at the breadth of market performance, it's also very thin. Unlike what we're seeing in the US, where there has been a significant year-to-date upside, and US developed market stocks kind of pricing in this whole different narrative relative to the bond markets, for example. So whereas maybe in the US, we'd be more concerned or quite concerned about any reasons to sell. I don't think. I mean, unless there's like maybe if the debt ceiling impasse hasn't been showing signs of any resolution, or maybe if the macro data were coming in really poorly, like employment might be coming in high, signaling like a hard landing for the US economy, then that also spells bad news for the other emerging markets, including the Philippines. But since it's still pretty much soft landing type of scenario, soft landing narrative, we do really have a chance, or it puts us in a good position to outperform, I think. So even if there's a sell-off in the US for whatever reason, actually it's just quite stretched over there. I don't think it's going to drag us down unless the narrative becomes about a hard landing recession.
Yeah, well, the U.S. debt ceiling impasse, Sandra, there is progress. We're seeing at least some form of consensus from the House of Representatives and the the group of President Joe Biden, the Democrats, but still it is forming a cloud that's hovering over sentiment, at least, not just in the US, but in other global markets. Now, how is this going to play out, given that there will still be an extension? They have not decided on it. There is nothing conclusive about agreeing to the debt ceiling as of the moment, and it is affecting markets unnecessarily, if you will.
Yeah. Actually, I think in the base case, the chance of it getting resolved is higher. I think that's what markets are also expecting. The funny thing is, it's kind of been an effective distraction from really the bigger issue, which is central bank policy, inflation, strength of the labor market in the US. I mean, those are still the more significant drivers. There ought to be the more significant drivers of markets. And that's the divergence we're seeing between equity markets and bond markets. On the equity side, there is still quite an optimistic scenario that's being priced in, and that is that the Fed will be cutting rates soon. They're pretty much over the inflation problem, which is, we're really not there yet. That's not what the macro economic numbers are showing. So that can really a trigger, like maybe debt ceiling impasse can weigh on that heavily, and should it pan out that that impasse is overcome, maybe equity markets might cheer it a little bit, but I would think that would be a good opportunity to unload some of that developed market equity risk.
Yes, because really volatility is still the theme. I think it will be the prevailing theme for the rest of the year. Now, Sandra, how challenging is it for fund managers to balance cautious optimism, which is the byword these days, the advice to stay light because you cannot be too invested in a volatile market, and yet encourage investors still to continuously participate in the market because stocks are now at attractive price levels? I mean, how do you do that?
Well, as professionals, we do have our investment process always to go back to, and that really anchors the day-to-day conduct of our jobs. And if we go back to what the macroeconomic environment is saying, what the business cycle is saying, it's nothing like, I would say it's not the same as 2020 when you had the shock of the pandemic. We've seen inflationary periods in the past. We kind of have a sense of how the Fed or the central banks are going to manage that. We've gone through in more recent history, the systematic crises of, for example, a global financial crisis, etc. So it's just another day in the office for us. And how do we continue our cautious optimism? We make sure that we are positioned the way we want to be, expressive of our views, but also managing the risks. So we are the first ones who will tell you that, we can be right, we can be wrong. What's important is you position your risk the right way, so that if you're wrong, it's managed. We have this whole process, as I mentioned, that kind of gives us the ability to keep invested, manage the downside risk, and for sure not miss any opportunities. I would say, broad strokes, this is a pretty, I don't know, I don't want to say, it's a rare opportunity to see the market this cheap. If you just look at the forward price to earnings ratios for the rest of the year, we're at around 12 times. That's like deep discount, at least 30% discount from where we've seen it in the last 10 years. We've seen it as high as 22 times.
Yeah.
So there's a lot of money that can be made for patient investors who are able to take advantage of these situations.
All right. On that note, we thank you again for your insights and market guidance, Sandra Araullo. Thank you so much. Have a good day.
Thank you.